let's maybe start with just a basic question here from David, and he submitted this earlier in the webinar, but he just wants a simple definition of human capital.
I like to talk about human capital also as earning power. You could think about the amount of earnings that you can generate in your lifetime as a measure of your human capital. And often we talk about different components of human capital. So we can think of what we could call firm-specific human capital, and that would be the amount of extra income that you can get if you stay with your current firm, your current employer. And that you could think of that, the components of that as being the relationships that you have with people in the company that would be lost if you left the company. Those relationships are valuable because they help you get things done. And they're valuable to the company too, because they help the company accomplish more and earn higher profits.
Okay. This is a question from Jose about an earlier part in the webinar. He asks, is there a tax break for having a child? And if so, did Rick factor this into your calculation?
If there are tax considerations for having children, and those are captured by Maxify. So to the extent that there are such benefits, they are captured by Maxify, I guess I would say.
This is a question from John going back to childcare. He asks, is the assumption is that childcare equals her earnings? $3,000 per month for childcare, it seems too high by half.
Mm-hmm. I did that to make a point. I did that to make the point that even though the child care is equal to her earnings while she's working half-time, it's still beneficial. So to the extent that it's lower, it's going to be even more beneficial for her to work half-time from a financial perspective. And it would be possible, it is possible to spend more than $3,000 a month on child care. Some families have nannies, for example, and that could be as expensive as $40,000 a year, easily.
This is a question from Jerry. He says, please explain why you use such a low real rate of return in your models. Is this comparable to the last few decades?
The real rate of return is actually right now lower than what we're using in our models. The real rate of return you can calculate by looking at Treasury inflation protected securities and standard Treasury bonds, and looking at the you can calculate the implied inflation rate by looking, or the forecast inflation rate by looking at the difference between the two, and the return on inflation protected treasuries is negative now, and that is widely regarded as a good measure of the real risk-free rate. And you want a risk-free rate in order to be able to calculate present values.
Right. This is a sort of a comment, but maybe an open question from Christopher about the last section of the presentation, focusing on retirement. He says, the assumptions of this analysis is based on investment only in IRAs. They also assume fairly high income and no uncontrollable expenses along the way except divorce. May I suggest there is a need for conservative spending to enable people to invest personally using Roths for greater financial stability? What do you think about that?
Well, I'm not sure that I guess I wouldn't say that I think that Roths have any particular advantage relative to traditional IRAs from a stability perspective. There may be advantages, uh, a lifetime advantage in terms of after-tax net rate of return for one or for the other, depending upon the pattern of earnings that one experiences over time. In terms of risks and of the sort that he's describing, that is of course true. In this webinar, I chose not to focus on risks, but rather on just the simple issues of where there are no risks. We can introduce risk. The same general conclusions apply, but they're going to be, you have to pay more attention to the caveats. And my view was that for the purposes of this discussion, that would be, we already, I already ran over. So if I had included the risks, we would be here until next week.
Yeah,
but I take
well,
the point.
maybe I can just add a few cents in here. It's Larry Kotlikoff. In these kinds of analyses, you want to be, as the questioner was kind of suggesting, be conservative. And so using the safest security that you can invest in, which is the long-term Treasury Inflation Index bond, which is the default rate of return, real rate of return that we're inputting into the program. And as Rick said, it's actually about negative 25 basis points, about negative 1/4 of 1% over 30 years right now, which is truly crazy and unusual, but that's what it is. But using a safe rate of return, a conservative one, is appropriate, especially if you're thinking about making an investment, which is a for sure outlay. I mean, the government is definitely a for sure expenditure, talking about the costs. And then on the side of how should you think about the earnings? So as Rick was showing, there's a huge range, and I would say running different alternative profiles with different assumptions about how much you'll earn in the different careers is the way to go. But again here, erring on the downside, considering perhaps the 25th percentile, 25th lowest possible earnings would be a good way to go. And as Rick says, there's lots of different schools to go to, so you can get a very expensive college degree, or you can get a very inexpensive college degree. And some places that where the net price, if you really shop around, the cost after you get support from the college and from the government, the federal government, the net cost for a top school could actually be cheaper than for a not so great a school. And that's also true with graduate schools. There are some programs that are much more expensive than others, especially if we're talking about public, professional schools that are being provided by a state university versus a private college. So anyway, it's really a huge range of prices out there for getting an education, and it's worth a shop. You can make a lot of money by not spending a lot of money. So I'll give it back to you, Rick. Okay.
Here's a question from Jeff about life expectancy or maximum ages of life. He says, I always see life expectancies at 100. The probability of a person who is currently 65 living to 100 is between 3% to 6% based on gender. Should we always assume 100, or is 90 or 95 more realistic?
I think it's important to distinguish between life expectancy and maximum lifespan.
Right.
Life expectancy is the expectation of the distribution. So for somebody 65, again, depending on gender, depending on health and so forth, life expectancy is somewhere in the high 80s. But if you plan for life expectancy, there is approximately a 50% chance that you're going to be too low. And my favorite line on life expectancy or on lifespan is, if I plan for you to live to be 90, and then you come to me at 90 and you say, well, we spent the money, I don't have anything that I can tell you to do, because we can't go get that money back. We can't go back and reduce spending. I think that what one can do is to take advantage of the assets that are linked to lifespan. So getting as much, the largest possible Social Security benefit, taking or annuitizing assets, or taking pensions or retirement assets as annuities. Both of those produce income that you cannot outlive, and makes and both of those make it less important, make the lifespan that you choose less important, because the income is going to last as long as you live.
This is a question from Matthew from earlier on in the presentation. He asks, why do you classify retirement savings as an expense?
That is a really good question. Let's go there. Okay, so you notice that on the asset side, we've got retirement account withdrawals, and there are, on the lifetime balance sheet, there are a number of different ways that we can assign cash flows, either as assets or as spending. And the judgment that's been made in this version of the lifetime balance sheet is that want to have retirement account withdrawals, which are taxable, as income. And in order to not overstate the size of that benefit, we have to have the contributions on the expense side.
Okay. This is another question from, well, let's see here. This is maybe a question that Larry might want to respond to, but this is from Ed. He says, do you ever consider the risk of the failure of the dollar, in effect hyperinflation entirely, given the deficits the government creates year after year? If so, how does one plan for this?
Well, I'll take that, and Larry can follow on if he likes. So I think that there are two approaches that, or two scenarios that one can imagine here. And I will say that I am sympathetic to that question, because I am concerned about the deficit and the potential for inflation. For inflation, and I guess for certain degrees of hyperinflation, Treasury inflation protected securities are an investment that will protect you and will protect your resources, even in a circumstance like that. If we were to get true, well, I shouldn't say true hyperinflation, if we were to get hyperinflation, extreme hyperinflation, tips adjust on a monthly basis. If you got in hyperinflation to the extent that tips didn't adjust fast enough, then there is not a financial asset that I could recommend. And then I think that's beyond the scope of what a financial planner can help you with, or even what an economist can help you with, because there's no financial asset that works well in that circumstance.
Yeah. So Rick, let me just pop in here with one idea, which is a little bit unusual, but if let's say you're really worried about inflation, so you might take out a bigger mortgage on your house, a bigger long-term, like a 30-year mortgage, if you could, and that may require you still to be earning money, but let's suppose that's the case. And then you could buy just regular long-term treasuries. Now, what happens? It's kind of on the face of a losing proposition, because you earn a negative return after inflation on the inflation index bond, and you've got this mortgage that might be at 2.5%. So you're borrowing at a high cost and you're investing at a negative return. So it all seems pretty dumb. But what if inflation really takes off, like Rick was suggesting, maybe 10%? I mean, the government is printing money out the wazoo. It's borrowing money out the wazoo. There's just unbelievable fiscal excess here, and monetary excess, with no notion that any country's ever gotten into trouble like this in the past. But we know in the last century we had 22 countries that ran hyperinflations, including Israel is an example of a country that's pretty solid government that was running a hyperinflation. But then there's Russia, and ran one, and obviously Hungary and Germany in the 20s, and Venezuela of late. So, but if you really had a high inflation, what happens is that you'll lose money on your you won't lose money on the tips. You'll still get the basically slightly negative return, so that money will basically stay fixed and adjusted for inflation. But where you'll gain is that the mortgage that you owe will decline in real terms. You'll pay back that mortgage in watered down dollars. So you'll have, suppose you borrowed $100,000 and inflation went up to 1,000%. You bought tips with $100,000. Well, you basically have $100,000 for free, because the mortgage repayment would be, in real terms, nothing. So a mortgage in the context of inflation, high inflation, or even moderate inflation, is a good hedge. There's lots of reasons not to want to have a mortgage, because they're tax losers these days. Most people are not itemizing, and they're also financial losers, because you can't safely invest at the same rate that you can safely borrow. And there's about a 1 percentage point differential there. So anyway, a mortgage comes in handy as a hedge against inflation. There's also some other things. There's clearly, you could put money into gold or Bitcoin, or maybe commodities in terms of those kinds of securities. Real estate, if you're in a house, you're getting the services from a house, and the fact that the price of the house goes up or down, as long as you're living in the house, you're still getting those same real services. So that's if you're just living in a house, you're going to live until the end of your days. Then once you're in that house, there's no risk associated with it except for termites at all with it. So you can ignore what happens to prices in general and to the house price of your house price in particular, if you're not going to move out of it. So those are some ideas for staying safe. But yeah, I do think inflation is a big concern that we have to think about. We've got one administration just went out running, I think, $24 trillion. I don't know. I've lost track of the enormity of the numbers of dollars that they borrowed. And what they're doing is they're borrowing the money from the public, and then the Federal Reserve is printing up new dollars and using that to buy up the government bonds. So we actually have just more money chasing fewer or the same number of goods out there in the economy. And ultimately, this could lead to inflation for sure. because it has in the past. Anyway, I'll stop there.
Okay. Here's another question about rate of return from Jerry. He says, my 401k investments are 60% stock, 40% bonds. What real rate of return should I use in the Maxify model?
Let me take that one too. 60%. Yeah, it's tricky. I mean, the stock market people think is overvalued. I'm not here to give any investment advice. That's not part of our company's. I'm just throwing out some ideas of what might be decent hedges for inflation. But if we do have inflation, then holding long-term bonds, if your portfolio is, let's say, 50% of bonds, and we have high inflation, that's going to lose a lot of money because the price of those bonds is going to drop dramatically unless they're inflation protected bonds. So I have to say that there's not a lot of safe places to invest money kind of in broad. I don't see the stock market as particularly safe right now. I think the long-term bond market is extremely risky. I personally am not getting near that. And I think if you can invest in individual stocks that seem to be high value stocks that you know a lot about the company or someone you really trust has done their homework on the company and that stock is selling a lot less than comparable stocks that are in the same industry, that might be worthwhile. And then trying to be more diversified in terms of commodities, perhaps foreign currencies. The dollar, if the dollar loses, if we have inflation, we're going to have the dollar lose value. So there are mutual funds where you can invest safely, or ETFs where you can invest safely in foreign currencies, and even Bitcoin is an option these days as a store of value, because Bitcoin has a limited supply by definition of this currency. So it's the only currency in the world that I know of. There might be other electronic currencies or e-currencies that have this property, but the Bitcoins definitely have a fixed supply built into the way that system works. So they can't really lose value in the sense of being overproduced. And there's other commodities like silver, other things that usually do well in recessions. But this might be a time to think about real estate, think about land investment, think about things that are physical. When they had a devaluation announced in Russia a while back, everybody ran off to IKEA to buy furniture because IKEA wasn't in a position to change its prices quickly enough. So there was a huge run on IKEA furniture in Moscow. That's sensible move in this context, trying to get something physical that will retain its value. Anyway, Rick, you might have some ideas about this yourself.
I think if I were to address the question directly, while I am concerned about inflation, I'm not forecasting runaway inflation. I think it's just something that one wants to protect against, and tips allow you to do that. So if I were talking about a 60-40 portfolio, I would have bonds with prospectively a very low return, 0%, 0.5%, something like that, and stocks with also a lower forecast return than historically, so perhaps 5%. So I'm using 3% real, maybe, for a 60-40 portfolio.
Yeah, so you're saying you put the bonds into tips, and when you run Maxify, use a very conservative assumption. And we're using the tips negative 25%. I mean, that we're going to do an update in the next few days where the default inflation rate will be 1.5%. The default return on bonds will be 1.75%. So that's going to lead to about a negative 25 basis point.
Yeah, I think that's consistent with what I'm saying. It's not a large return, and but so I think that to speak directly to the question, what would I use for a 60-40 portfolio? I think we've said, of the order of 3-ish%.
Yeah. Well, I mean,
have more questions?
I guess I would assume frankly, I would not, because the market could drop a lot. I would.
Larry, the market could always drop a lot, but when we're forecasting not for the next year. We're forecasting for the next. I mean, if the person that we're talking to is in their 40s or 50s, we're talking about the next 50 or 60 years. Okay. And
that's fair. I would just be in that. I would just be. We just have different kind of fear factors here. you versus me on this one.
Yeah, I think that's fair.
Yeah.
Okay, let's move on. Yeah, so we have pretty few questions left, but let's just try and hit a couple of these that are specific to the presentation. One is from Nadia here about some of your earlier bar graphs, and I assume the graphs showing different possible incomes later in life. And she's wondering what exactly is the x-axis supposed to be?
Bar graphs. So, so if we're talking about bar graphs, there were two categories of bar graphs. Okay, one of them is this one, living standard, and the horizontal axis is they're just categories, right? These are just different scenarios, just different scenarios.
Right.
So if in this case, if Cleo retires at 60 or at 65 or at 70, how much could they spend on discretionary as discretionary spending in each of the scenarios? So, but there's no quantity on the x-axis, right?
I believe that's what she's referring to. Yeah.
Okay. So these are just different scenarios, and we're looking at what is the sustainable discretionary spending in each scenario. And the sustainable spending is the amount that could be spent each year for the rest of their lives on the discretionary category.
Right. And this question is from Ayer, and I think it's just maybe you just want to confirm what she's asking here. She says, and I assume this is about Cleo, but she's asking, is the salary assumption that she'll have a higher full-time salary only if she works half-time rather than not working in the first 10 years?
That's right. So the idea is that if she does not work in the 10 years after Daniel is born, then her human capital will depreciate. Her network she will be less known in her career. Her skills will depreciate, or other people will accumulate skills that she will not accumulate. Other people in her career, her former career, will accumulate knowledge that she would not accumulate. And therefore, her human capital will be less valuable if she doesn't work at all than if she works half-time. And we've indicated that by having her earnings after she returns to work full-time be higher if she worked half-time in the interim than they would be if she didn't work at all in the interim.
Okay. So we're not getting any questions here coming in really specifically about the presentation at this point. I think that we have one question here from Ken, which is sort of an interesting question, and then maybe after that we can maybe conclude the presentation. This question is from Ken. He says, thinking of good public policy, like the first example of the household with childcare, it seems an expansion of childcare benefits is a win-win. Higher participation rate, higher earnings mean higher tax revenues, etc. What do you think?
Well, as with any public policy, one has to think about the costs as well as the benefits. And I think it depends on how much it costs to provide that care. And how accessible the care is, and so forth. So I think the devil is always in the details, and I will. This is not something that, as a financial planner or a financial advisor, I'm thinking about a lot carefully on a day-to-day basis. So I will stop there and say you got to think about the costs as well as the benefits. It's easy to enumerate the benefits. It's less easy to enumerate the costs.
Well, yeah, let me just add that, I basically think we should be providing a lot more daycare and childcare for children, so that women don't lose experience in the labor market, because they're the main folks who are ending up staying home taking care of the children. And if we had more support for childcare, we probably have a better industry in terms of daycare being set up. Yeah, but there's negatives too. Obviously, you could end up the kids may not get as good an upbringing at some level, or as much caring. But I think in general we should move towards the European model on this. They seem to be quite successful in getting everybody fully activated in the labor market, and there's really long-term implications from missing 3 or 4 years of work from raising children. So I'm kind of, as a public finance economist, I would be pushing for this. Anyway, that's just my personal opinion, but Rick's absolutely right. It has to be looked at very carefully. Rick, I just want to also just to thank you so much for this really terrific presentation. The slides are exquisite. You spent so much time thinking through these cases. You got so much of a variety of that's something here for everybody. I'm sure that a lot of people are going to be watching this and getting a lot of benefit out of it. So thanks again, as ever. Thank you.
Well, thanks for having me.
Yeah, so thank you, everyone. And that concludes our webinar today. I just want to remind everyone, yes, we have recorded it, and we will be sending it out over the next few days alongside the slides. So thank you guys so much, and that concludes our presentation.